Bill Dudley, in your important essay yesterday, near the bottom of the essay, you made clear this is a Fed that needs to be malleable and supple in their thinking. Describe that.
Well, right now it's all hands on deck, making the economy as stimulative as possible. You got the monetary policy, basically, interest rates at zero. Fed's doing quantitative easing, large fiscal package coming. So that's great for now. But we are probably going to, if the vaccine dissemination works, we're going to see a very strong recovery in the second half of the year. And I think we're going to see pressure on resources faster than what people anticipate. I understand why the Fed's doing what they're doing. I mean, they don't want to prematurely change expectations about future monetary policy and thereby tighten financial market conditions. But we have to recognize that if they're successful, they are going to have to change, and financial conditions are going to have to tighten.
There's any number of ways to go here, Bill Dudley, but I think the heart of it is a broad public that looks at the fact of inflation, is seen in their monthly payments. I would note, folks, rents down lower here in the last inflation report. And Bill Dudley, pros like you looking at the expectation of the expectations of inflation. What are we expecting right now?
What's been interesting over the last 3 months or so is that inflation expectations, if you look at the spread between 10-year Treasury note yields and 10-year tip yields, that's gone up by half a percentage point. The 10-year break even now is running 2.2%. That's not really very far away from the Fed's long-term target. So, the argument that we had to keep monetary policy easy to support inflation expectations, that seems to already have been mostly accomplished.
You've lived and breathed this, though, Bill. Would you look at that as a market pricing in the risk of more inflation, or actually pricing in inflation? Do you see that as the outlook for inflation, or just the market pricing in the risk of it?
It's the outlook. I think it's the outlook because this is about what's going to happen over the next 10 years. I mean, I think people recognize that the Fed is all in. They're going to be very accommodative. The new monetary policy regime means that they're going to push inflation above 2%. People find that credible, and Chair Powell is reinforcing that through his statements. And so essentially the Fed is accomplishing its mission of keeping inflation expectations well anchored around 2%.
So, Bill, what I need to understand is what they'd respond to. So as you remember, Governor King over at the Bank of England, we had inflation north of 5% in 2011. We had it north of 3% under Governor Carney in 2018. They looked through it. They used that word transitory. But what's the kind of situation you think the Fed responds to and the kind of situation they look through, so to speak?
Well, I think they'll look through it if there's a little bit of a bubble of inflation, in the second half of the year, just because you have a surge in activity and, prices go up in some service areas. I think they'd look through that. I think what they're going to watch is the labor market. I mean, at the end of the day, inflation is about pressure on resources. And so I think they'll watch the labor market. I think the thing that's different about this expansion compared to the one following the great financial crisis is households have a lot more ability to spend and businesses have a lot more ability to spend. You don't have the kind of overhang of mortgage debt that you had following the great financial crisis. You don't have so I think that the economy could bounce back much faster than people anticipate. Chair Powell is absolutely right. There are about 10 million people out of a job. And so the unemployment rate understates the amount of slack in the labor market. But at the same time, if we actually do conquer the pandemic and allow opening up and getting people back to work, this could be a bounce much faster than people anticipate.
I will say, Jared Bernstein of the White House Economic Council did say that people are saving some of that cash that people say they're going to spend in order to make all of the debt payments that have been deferred. So there could be a little bit of that hangover as well. But it goes to a key point that you're talking about, which is the difference between reflation, that a lot of people are saying is what we're seeing right now, versus inflation, which is what you're seeing we should expect later and what a lot of people are saying. When do we shift from reflation to inflation? What do we have to see for this to be more sustainable?
Well, end of the day, it's going to be about how long does it take the economy to get back to a 4%, 3.5% type of unemployment rate. I think that could actually happen a little bit faster than people think. Janet Yellen, the Treasury Secretary, just last week talked about how if we get the fiscal package, we could be at full employment next year. So this could happen much more quickly than the Fed's current forecast. The Fed's current forecast, but we don't get back to full employment until 2023. The Fed doesn't even tighten until after 2023. So I think the risk to the market is it just happens in a more compressed time frame than people are expecting.
Bill, I just want to finish on something important just quickly, if we can wrap things up. Just how the reputation of the Federal Reserve has evolved in the last several years and how there is now an increasing willingness to focus on society and perceived injustices as well. And I was familiar with the kind of response where a central banker would turn around and say, we can't address inequality with the brunt tool of interest rates. And now the approach feels very different. That speech yesterday from Chairman Powell felt different. Do you sense a change too? And what's behind it, Bill?
I think there's two things that are driving it. Number one, the current Fed policy is benefiting rich people more than poor people, right? So the Fed is very aware of that and wants to make it clear that that's not really the goal of policy. The goal of policy is not to make people more wealthy who are already wealthy. And the second thing, I think, is the fact that the last cycle, the Fed pushed the unemployment rate very low and there was no inflation. And so the Fed realizes that maybe we can go farther on the labor market than we thought and get more people employed than we thought before. And so they don't want to make the same risk of being too cautious about pushing the labor markets to a high degree of tightness because maybe they can go farther than they thought.